Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, gentlemen, welcome to the Pilot Money Guys. I'm your host, Charlie Mattingly. Today we have special guests, Nolan Clark and Andy Christopher. Both are veterans of the podcast, but welcome back, gents.
Hey, great to be here.
Thanks for having me, Charlie.
We're glad to have everybody with us. Thanks for joining us on this podcast. What is this? I think it's 118, if I remember correctly. No, 118 was last time.
119.
119. Flight 119. Last time was 118 with my man, Ryan Watson. So check that out. That was a fascinating one. And more about, just life in general, some struggles, some trials, success, what success means. Today, we're going to jump back into the nuts and bolts of investing and kind of a grab bag, if you will. In fact, we're calling this a lightning round with Andy Christopher, Nolan Clark. Gold
Excellent.
bugs, bubble talk, stock market crashes, etc. It's going to be exciting. So we're going to cover a lot of topics today. So we're going to cover a lot of stuff at surface level, but it's a lot of questions we've been getting, and I think a lot of legitimate concerns that are out there. So I'm excited about that. I'm excited to have you guys on today. But before we jump in, thanks everyone for sharing the podcast, forwarding it on so we can reach more people with our content, help as many people as we can. Just trying to bring clarity, transparency to finance in this confusing world sometimes of information that we're overloaded with. And so trying to bring some clarity to that. But thanks for giving us a rating and review. We appreciate it. Also, we still have the Pilot Wealth Index on. If you're listening to the podcast, you should see that link right on the front there where the podcast is. Go in there, take a shot at it, see how you're doing, see if you're thinking about the right things. We tried to design a questionnaire just to let you know. It's impossible to let everyone know if they're completely on track, but are you thinking about the right things? And so it's a pretty good indicator. If you have any questions about that, feel free to email, call, and we'll reach out to us somehow. We'll help you out. So also the podcast will be on YouTube. Check it out. If you want to see how handsome Nolan is, then just go to YouTube and
go with the podcast.
That's right. Stay with the podcast. We talked about maybe trying to emulating ESPN Game Day. You're Pat McAfee. At any moment, you're going to take your shirt off and start, getting everybody fired up. Maybe. Oh, no?
Hey, then Andy's going to be Nick Saban, right? Giving us
That's right. Yeah.
Giving us the hard takes.
Yeah.
Oh, Nick Saban. I think he's hilarious. But anyway, all right. And I'll be, let's see, what's the college football coach's name? Just took a job, LSU. Help me out.
Oh, Lane Kiffin?
I'll be Lane Kiffin. Yeah.
Don't leave us, Charlie. Don't leave us.
Who wants to hire me? Who's the highest bidder? Anyway. Yeah. Awesome. All right. Before we jump in, Nolan, give us a fun personal fact real quick. I picked on Andy last time, so now you get to kind of share with us. What's going on in your world, man? Anything interesting?
Yeah, our son just turned 1 on Thanksgiving Day. So he was a turkey baby. So that was fun getting to celebrate him.
Awesome. Well, that's very cool. Well, thanks again for joining us. Let's tell you what, let's jump in. Let's jump in and get started because we have a lot of questions. We had 10. I'm always about the top 10, but we deleted one before we started here. It's probably a wise decision. So Andy, Nolan, I'm just going to start firing off questions that we get a lot. We're thinking about a lot. We see in the news quite a bit as well. One of those is, man, we must be at a market peak. The markets have been doing so well for so long. How could the market not be going down soon? And if we are at a market peak, what does that mean? Maybe I've got a lump sum of cash. Maybe I just hold off on investing, or maybe I sell out of everything. What do you think, Andy? I just sell everything. I hold until the market goes down. A lot of our listeners are laughing because they know that I'm exaggerating. We would never do that. But nonetheless, there are some things that we think about, or some folks ask us, hey, we're at a market peak. Is it normal? Is it too much? Is it too high? But Andy, what do you think?
Yeah, a couple of things come to mind right off the bat. One is if you never know if we're at a market peak, right? Mm-hmm. And then are we at all-time highs? I think the market is kind of always at our all-time highs. That's sort of what we expect, actually, right? Like we're in a robust economy that's growing. We have GDP, that's growing every year. And so when we have that, like the market is going to reflect that growth. And that's not to say that there aren't places that are over or undervalued within the market, but we kind of expect the market to go up. That would be really quite bad if it didn't. So like, should you come all the way out? Probably not is I think is the short answer. But it's now is a good time to think about, are you properly allocated? If you're approaching retirement with 100% stock portfolio, maybe now is a time to think about what is my appropriate mix between stocks and bonds. Like let's do that now at the all-time highs without trying to time the market, but at least have that discussion, with your family financial advisor.
There you go. I love it because, we have to be ready for the market to decline, crash, whatever you want to call it, at any moment, because we're not going to know that event, that moment, that one thing that kind of causes the cascade effect. So we do have to be ready for that. And I think it's a good mental exercise, because what we've seen happen on our end is where the market sputters, let's say it goes down 10, the natural reaction, we understand this. We feel the same way. The natural reaction is like, oh, I want to become more conservative now. And unfortunately, that's going to cost somebody some money if they decide to do that, because it sounds totally rational and makes sense on the surface, but to become more conservative, you have to sell equities that just went down, in my example, 10 to 15%. That's going to cost you money permanently. That's making a temporary loss permanent. And that's where we get into this habitual exercise of selling low and buying high over and over again, because we want to, hey, let's become more conservative when the market goes down. Let's get more aggressive when the market goes up. Those are two very, I don't want to say dangerous, but common emotions that we feel that cause us to have poor performance. Nolan, any thoughts to add on that?
Yeah, to Andy's point, he mentioned as investors, the years go on in the market, we kind of continue to see these new highs. And before the show here, I'd written down since 1926, the U.S. market has ended on a new high in about 1 out of every 6 weeks. So if you were to look at a 90-year growth chart, right, of the market, the U.S. market, it would be kind of that up and to the right growing. Now, if you zoom in, of course, that's where we get into these questions, right, of are we in a bubble and all those things. But I think zooming out, even just at its fundamental sense of investing, what is being an investor? It is uncertainty. So I think a lot of the questions we're going to be asking today are going to be hitting on that fact, is that none of the three of us on the call here know the answers. It's all uncertain, right? But what can we do to maybe mitigate some risk? Or I like how Andy mentioned, just looking at your certain circumstances. If you're close to retirement or you don't have as long of a horizon anymore, trying to do whatever you can to put yourself in the right spot.
Yeah.
That's amazing. I didn't know once every 6 weeks. That's a great stat.
Yeah.
From our guys at Dimensional.
Nice.
Yeah.
Excellent. It is pretty amazing. I think there'll be times occasionally where we go through 1 to 2 year periods of maybe the stock market is, in fact, I think fall of 21 till maybe fall of 23. I can't, maybe, not exactly on that time frame, but it was pretty levelish, just kind of puttered around there and kind of went down at times, went up at times. But I remember that was 1.5 years to 2 years of people going, hey, I put, my 401k contributions and where'd they go? And, it's not going up, but that's more the exception, and that's going to happen. But like you said, market highs are not unexpected, and that's part of the market. And that uncertainty, Nolan, that you talked about, that's why we get paid an investment return at all. If there were no uncertainty, there'd be no market returns. So that's unfortunately the price of admission, as they say. All right, very cool. All right, let's see. That's the market peak. Now, the next softball question, Andy, goes to you. Will the stock market go down next year? We're recording this. It's early December. Our folks will probably hear it mid-December. We want to know, will the market go down next year? Yes or no?
One word, yes. I'm going to say yes. Yeah, and I think we had looked at this before the show. And another kind of really interesting fact is if you look at the S&P 500, it's had negative intra-year returns every single year since 1950. And a drawdown, negative drawdown, right? And so, when you look at those numbers and you go, wow, every single year it's gone down, then I feel pretty confident that 2026 is going to be like every year
Absolutely.
since 1950.
Yeah, kind of a trick. Yeah, kind of trick question because the market does all kinds of crazy stuff intra-year, but we only measure it by the calendar year. So, right.
Yeah.
And anything that's happened intra-year, we just kind of conveniently ignore, which I think is probably pretty healthy. Should probably ignore a lot more of it. But nonetheless, it goes down. I'll share that graphic in a minute because it's pretty amazing. But let me read the statistic first. I took, there's an article from our guy, Ben Carlson, and he says, yes, the stock market averages approximately a 16% intra-year decline every year. Going back to 1928, the average peak to trough drawdown in a given calendar year is minus 16%. That's higher than it's seen because drawdowns are worse than average. And then, you got 19% in 2025. We had a 19% drawdown, 18.9 to be exact. It was in April of this year, I believe it was. Yeah. Then there was another one, big one in 22. But except for 22, those years ended up being positive. So I'll share with that graphic really quickly because it's pretty fascinating to see. And I think this is healthy to know that, again, back to Nolan, what you're talking about is, or what you mentioned is, the stock market is full of uncertainty, and that's why there is a return. But this is the chart taken from Ben Carlson's A Wealth of Common Sense blog. We highly recommend that. Check it out. We'll put it in the show notes. But this is S&P 500 returns and intra-year drawdowns. In fact, if you look at the right column, the drawdown, there's no year since 1950 that is green. That means at some point in the year, there was a pretty substantial drawdown. Some of them are in the single digits, but most of them are either high single digits or double digits pretty regularly. So it's kind of amazing what goes on in the middle of the year that we, like I said, we ignore sometimes, which is for the better. So expect market decline.
That's it. Yeah. And 2025 is not there, but you hit the nail on the head. We were down S&P 500 5.6% for the month of March. And I think we're up 18% year to date. So just a good reminder.
Absolutely. Yeah. All right. Let's see. That's a good one. So we've answered that one clearly. And let's see, compliance. Past returns are not indicative of future. Okay. Make sure I explain that correctly. Cannot be definitive on anything in the world of investing. So let's understand the tongue-in-cheek nature there. All right. So if we know the markets are going to go down at some point, which they will, what do we do? There are some practical things. And again, I think this is a great mental exercise. What should we do right now? Let's go ahead and assume that the markets will go down, and let's prepare for that. But Nolan, I'll start with you. Anything top of mind? What's important in your mind as you start to grow your family and you're like, man, the market might tank? I know you're a young guy, but what are you thinking about from the young guy's perspective?
Yeah. So, for me, I definitely stocks I'm 100% stocks right now because of my age for retirement accounts, at least. But that's just one part of the equation, right? What you're getting to, Charlie, is, you're 100% stocks, but then what are you allocated in? What are you invested in? And so for us, it's, it's not only the S&P 500, which is primarily what we've kind of been talking about in some ways when you talk about the AI bubble and being concentrated and all these things. So for one, to answer that question is just try to invest as broadly as possible in other asset classes as well. So, I'm thinking international stocks, small value stocks, things that perform differently than just the S&P 500 stocks that we're thinking of. And really this year, as we've already mentioned, has been a great example, right? The information we would have said would have been the exact same in April, but it would have been a different feeling, right? Around the news headlines because the market was down. And so we want things that perform differently in different market conditions. So international's done really well this year. That hasn't been always the case in the past. Had a good few year run here, but that's kind of what we're looking at. Andy, what do you think about that? Anything you'd add?
No, I think you hit the nail on the head. It's like, and we probably do as a financial industry a disservice because we only talk about the S&P 500. Everyone only talks about the S&P 500, but there's so much more beyond the S&P 500. There's international, developed, emerging. There's small cap. There's of course bonds, real estate, and so I mean, if for me, right, I'm going to own the market. I want to own the market. I want all of it. And I want it all in a market weighted proportion because that's the price to clear the market. And so like, I don't want to be just in the S&P 500. I want to own the market. And that's my default portfolio as I think about it and want to allocate and then rebalance, right, as you think about it.
Yeah. Awesome. I mean, I think that leads us into the next question we get all the time. And that is, and it's a good question. Again, these are very rational questions. I'm not making light of them at all because, man, the evidence would point, Andy, that, man, I could just invest in the S&P 500 and be fine. And what do you kind of mentioned, hey, there's lots of other things. So why not just invest in the S&P 500 and be done with it? So you can continue on your thought pattern there because you were alluding to that as well.
Yeah, I think to get a little nerdy, it's, like S&P 500, as the name implies, is 500 companies, but you may not own, from a diversification standpoint, 500 stocks. In other words, because of the concentration, I think it's the top 10 make up 40%. Top 10 companies of the S&P 500 make up about 40% of the concentration within the S&P. And so when you look at those numbers, you probably effectively own maybe 50 stocks, right? So your S&P 500 is the S&P 50. And so you may not be as diversified as you think just owning that portfolio.
Mm-hmm. So the stock concentration thing right now, you're talking about the top 10, the ones we always know about. Amazon, Apple, let's see, I get them. Tesla's in there. I probably got 7 more to go, and I'm not going to try to rattle them off. I'll mess it up. But yeah, the big ones that we all know, Mag 7, whatever the heck we want to call it. So those are so dominant, but why not just invest in the Mag 7 then? Maybe I'll just get to snag 7. Maybe I'll just snag the top 10 and go with it. You know what I mean? But any thoughts to that?
Yeah, there's a great chart. Don't have it in front of me, but it essentially shows the returns as companies become the top 10, the subsequent follow-on returns, and they're not great. They're not great. And so I think it just gets back to like, are we performance chasing? Right? I don't want to own the things that have just done really well because it's a pretty good chance there's going to be a reversion to the mean of those stocks. There's going to be some level of just below average returns going forward. And so that to me is like, I don't want to just own the Mag 7 because I don't have a very diversified portfolio. And historically speaking, I'm probably not owning things that have a very high expected return in the future.
Yeah. I do have the chart that you're thinking of handy because I think it's fascinating. So what I'm going to share right now for those of you that are watching on YouTube is exactly what Andy's just talking about. This was off of Rational Reminder podcast, episode 113. Yeah. So check it out. Another really good podcast that we like a lot. This was from Research Affiliates talking about exactly what Andy just mentioned. And this goes back all the way to the early 1900s when you had the invention of the telephone, some pretty big game-changing technology. And so there's been these top dogs in I guess we'll call it the S&P. Back then it was the Dow. But you've had these top dogs for a while, but they change out almost every decade. Now, we've seen a couple hang in there like Microsoft, and now Apple has been in there over a few decades, which has been the exception to the rule. So we don't know when those are going to change out. But the point of the podcast, and Nolan, Andy, pile onto this if you remember or have anything to add, but the point was that you get higher returns than the S&P 500 because you're exceeding expectations. So let's take Apple, for example. Apple has clearly exceeded expectations, but at some point, they won't continue to exceed. They will meet these amazing expectations that we all have of Apple. And the point of the podcast was that at that time, they will probably revert to the overall return of the S&P 500. So Andy, Nolan, did I get that right? Anything to add to that? That's kind of the point of the podcast anyway.
I'll let Nolan go.
Yeah.
Yeah, I think that makes sense. And back to Andy's point, when you talk about the S&P 500, or if we're going to get really nitty gritty, right? Like maybe it's really you're only owning 50 companies or 50 companies at least making up a large portion of that. I just kind of go back to what Andy said of like I want the whole market, right? Like I think of investing for myself at least as well, and I think for our clients that we don't have to hit home runs, right? Like I'm also trying to mitigate some risk too. And so I think that is part of the equation, right? I feel much more comfortable knowing I own thousands of companies that perform differently than just 50 of the big ones.
Mm-hmm. Excellent. Yeah, just for those that cannot see or listening, in 1980, the top dogs, the apples of back then were AT&T, IBM, Standard Oil, Schlumberger, great name on that one. I don't know what that is. Shell, Mobil, those are familiar. Atlantic Richfield, General Electric, and Eastman Kodak. So it's amazing. Those were the equivalents back in 1980 of what we're talking about, the Mag 7 or whatever. So it's pretty fascinating. But excellent point on that. Let's see. So we talked about the S&P. In fact, I'll confess at the beginning of this year, I told Nolan, I told Kevin, I said, look, dude, I'm done with international. I've had enough. I'm giving up on international. Now, I didn't know that it was going to turn around and double up on the S&P this year so far, as of December 1st anyway. But international in general is about, high 20s. S&P's in the mid-teens. So it's pretty incredible. Now, S&P, that's nothing to scoff at, but international has been on a tear this year. And it's interesting to have seen in the news lately, hey, there's a great thing going on. It's called international investing. And it's like, well, you're kind of late to the party if you're just now jumping on that bandwagon because of high returns. Like you said, Andy, chasing high returns. You got to be present. You got to be in the fight to be able to benefit from it. All right. Awesome. We didn't talk about the lost decade, though. Is that worth touching on a little bit, the lost decade in the S&P 500?
I love talking about the lost decade. Yeah, let's do it. Big lost decade, man.
Exactly. Yeah. So that's when I started investing. I'm a brand new investor in 1999. I'm like, man, I'm going to jump into this S&P thing. It looks awesome. And then 5 years later, 2005, I was like, I can't stand the S&P anymore. I'm done. I sold out of it. I shared this with one of our, we were having a discussion with a prospective client. And I said, yeah, the S&P is great. It's been the best performer up until this year. And I said, but in 2010, overall, it was it annualized a -1.5, something like that.
Yeah.
And they made a good point, though. They said, you're cherry picking the data to show that decade. And I said, that's absolutely correct. But we're also cherry picking data when we look at the most recent 10 years of return as well. So it's kind of difficult, but I don't know that anybody's financial plan could withstand a 10-year, even a break-even scenario for the S&P. Yeah. But Andy, what do you think?
Yeah, I think the lost decade, right? It's that 2000 to 2009. You had some pretty bad stuff going on. We had the tech bubble of 2000. We had the global financial crisis, and those are both kind of bookended that entire decade, and both pretty bad market scenarios. And you're right, S&P 500 was down a little over 9% during that period. But I think if you look at some of the other numbers, small cap value was up 231% in that same period. Emerging markets, 202%. So of course, you're not going to be 100% small cap value and 100% emerging markets. But if you had a portfolio that was not just the S&P 500, then you actually had probably some pretty decent returns, or at least positive annualized returns in your portfolio.
Yeah, absolutely. As we shift gears a little bit to the next question, I know we're building up to this thing that you have, Andy, for us on, are we in an AI bubble or not? So I'm just gonna hold off a little bit on that to build that momentum, because I know we're excited about that. But in the meantime, Nolan, I think we have a lot of folks that talk about, hey, why don't we own gold? Gold is killing it this year. And when I say gold, I mean the exchange traded fund gold or mutual fund equivalent. But man, gold has killed it this year. Did we miss out, or what the heck? What do you think, Nolan?
Yeah, that's a great point. I do think it has come up more as of late, as we would expect, because you mentioned, the returns have been great. And so I think that's when people really start talking about it and are more interested in getting into it, which off the bat, I'm thinking, as investors, we're trying to think maybe, most of the time buy low, sell high, but it is appealing, and I wanted to read a few headlines because we all see them, right? And so 3 headlines as of late with gold that I picked out here. What could stop the gold rally and its tracks? ? Not much. Can the gold rush continue? Warning signs for investors. And then lastly, Bitcoin, gold, real estate are key inflation hedges before 2026 downturn. So I think it's just interesting to think, you could replace gold in those headlines with really any asset that's probably doing well at a certain period of time, right? And so that's what's going to keep these questions coming. And so today we just want to go over, why are some reasons you may own gold and what are some reasons you may not want to own gold. As Charlie, as you mentioned, just to kind of throw the disclaimer out there again, when we're speaking of gold in this context, we're referring to gold on a stock exchange, such as the gold ETF, so not the physical gold at home in the safe. That could be probably a whole separate discussion on its own. But I did want to say too, and just acknowledge, I think gold is a very emotional thing. I think I was reading something the other day, it's talking about as humans, we kind of have we kind of lean towards gold in some ways, like for thousands of years, right? I mean, it was something you could exchange. People, back in the old days, people wanted to be buried with gold, right? We like shiny things and it makes you feel safe in bad times. And so we're not here to tell you like yes or no. It's more so, what are some considerations, right? And so when we think of any investment that you're going to invest in, we think, what's the goal of that investment? As a firm, again, that's what we're going to start with. And we think beginning with the end in mind. So when I take this money out to buy gold or whatever it may be, whatever investment, what will I be doing with it at the end of that timeline? So for me, if you were to ask me, Nolan, should you own stocks? I would say, well, it depends, right? For my retirement, I just told you, I'm 100% stocks, but if Claire and I, want to go buy a home and another home in 5 years, then I may not be invested. I won't be invested 100% stocks. I may not own many stocks at all, because at that point, maybe 3 to 5 years, the goal is just to beat inflation a little bit and be better than just having that money in cash. And so I say all that because when we think of gold, what is the goal with that? And so a few common ones we hear, and Charlie, Andy, jump in if have anything to add. But one thing I hear quite a bit is I want it for an inflation hedge, hedge against inflation. And so for any inflation hedge, I'm thinking, how much risk am I willing to take? I probably don't want something that's super volatile any more than inflation itself. And does it at least historically track inflation? For gold, it's been very volatile historically, even more so than the S&P 500. If you look back, I have a statistic here. It says from 1980 through 2019, so 40 years, gold lost money to inflation over that time. Whereas even the S&P 500, the worst 40-year return it's had was about 8.5% over that time frame. And so I just think for gold, in terms of an inflation hedge, if that's the goal, you probably don't want to invest in something that it can be that volatile over such a long period of time. It's just hard to grow, much less really preserve your wealth when you have a long string of returns like that. But I have one more little nugget, but anything to add, Charlie and Andy, to that?
So go ahead, Andy.
I was gonna say, it's just, when you kind of lay it out like that, Nolan, it's just, to me, it sounds like a market timing discussion, right? It's like, well, I want an inflation hedge, but then that means I've got a time when gold is going to do really well, and theoretically beat inflation. So now it's just, we know it's challenging, and once we start getting into market timing dynamics.
Yeah,
to cut you off, Charlie.
No, that's okay. It's also another one of these where I think it's called a recency bias, where we as human beings take the most recent data set. And that's what I was talking about earlier with cherry picking.
Yeah.
We take the most recent 5, 10, 15-year period and we go, that's the most relevant data. And we really don't know that to be true, because you just presented 1980 to, what'd you say,
2019.
2019. That's incredible. But I'm guessing from 2011, somewhere around there, gold started doing okay, probably still annualized, not less than inflation, I guess I should say. So it's interesting. You took a data set that shows, hey, it may not have outpaced inflation for a long time. So that's pretty incredible. A lot of people a lot of very smart people think you should have some gold in your portfolio. We don't particularly see the advantage of that as far as the diversifier and the volatility that you talked about, Nolan. So we think there are other ways to do it. But it's certainly a good question and one that I know people will continue to debate. And go ahead.
Right. No, it's a great question. I think, again, it just all goes back to what's your goal with the money, right? So if it's an inflation hedge, then maybe not, unless you're and are willing to maybe go 40 years of something that'll go be less than inflation, and it may not happen again, but it has happened before. And so the next thing that we hear is maybe a safe, I want gold so I can have this safe portion of my portfolio, right? And so historically, gold, and I just mentioned this earlier, it's had these long periods of underperformance. And so, just like an inflation hedge, really something that's my safeguard. I don't know if I want something that over 40 years, is going to return less than inflation. And so another statistic I had is if you look at the S&P 500 versus gold from 1970 to 2024, the amount of negative returns in between that time, the 1970 to 2024, gold was down 22, had 22 negative returns, and the S&P 500 had 11. And so, if you wanted this to be a safe guard in your portfolio, you would typically, again, want something that's just less volatility. And in that scenario, you may even just do better in the S&P 500. So Charlie, you mentioned Ben Carlson earlier. I just had one last thing here, a little tidbit from an article he had that I wanted to leave our audience with on gold. But he said it would be nice to own some gold when it goes through boom times like 2025, but you have to get used to not always owning the most popular asset each year. I like being diversified, but that doesn't mean you have to own everything. Sometimes you have to watch other people own assets that are up 60% in a year and be okay with the fact that you don't own any. Avoiding FOMO isn't always easy, but that's part of your job as an investor sometimes. So I thought that was a good way to frame it, that, when you are diversified, there's going to be some pain. You won't own every single thing. So I think, the last thing, just what's your goal with the investment, and is gold the right tool to get you to that goal?
It's good stuff, man. It's it's one that we always think about. We talk about a lot, even within our office. And the last thing I'll say on it is just like, I just like to own companies that produce something that are not just based off of emotion. So it seems like, I know there's gold miners, there's the industrial use for gold, I think a little bit, but anyway, so that's kind of just some things that we think about as well. But Andy, anything to put a bow on that?
No, and I love what you said. It's like if you had a long time horizon, maybe, but then I think in my mind, the best inflation hedge over a 40-year time horizon is, quite frankly, equities. And then you get the commensurate amount of return for the amount of risk that you're taking. If I'm looking for an inflation hedge in the short period, it's probably not gold with standard deviations and volatility in excess of the S&P 500. So I'd probably look for things like Treasury inflation protected securities and TIPS that are designed to function like a fixed income asset with a level of volatility and provide inflation protection.
Absolutely. Awesome. Thanks, Nolan, for that, man. Good words. And let's see here. I think we're up to the question now, Andy, that we've all been waiting for. This highly anticipated discussion about the AI bubble, or any bubble, or bubbles in the past. And what should we do about it? Can we tell if we're in a bubble? And any thoughts you have on that? Start us off, Andy. What do you think? Are we in an AI bubble or not?
Is this the college game day part where I go Lee Corso and I have the head?
Yes, you're making the game.
Put your bubble.
He put a bubble on his head. Yeah,
that's good. I like it. I wish I'd have thought of that though. I would have got a bubble hat.
I can go get a big bowl from the kitchen or something.
There you go.
And put it on. And it is the number one question we're getting, right? And a lot of it, I think, is just, it's self-feeding, right? It's like, we must be in a bubble because everyone is saying we're in a bubble. And I think the most recent bubble, if you will, that feels similar to where we're at now is probably the 2000 tech bubble, right? That was the pets.com. We just talked about the lost decade and what that looked like. So one is who knows, right? We're never going to know if we're in a bubble. And the only time you're going to know that you're in a bubble is after the bubble bursts, right? And so number one would be, again, be diversified in your portfolio. That's the best advice I think we can give for anyone who's concerned. But I do think there are, it's easy to draw parallels and try and say everything is kind of like the past. There are some important differences. One is these companies that are these bubble companies, NVIDIA, Amazon, Apple, right? These are good companies. They've got great earnings, right? We were looking at that earlier. Their earnings growth is frankly beating the S&P 500 2024, 2023, right? They outperformed in earnings growth, right? So these are companies that are making money, this magnificent seven. I always joke, the Amazon man is at my front door at least 4 times a week. And I'm only saying 4 to not embarrass myself, right? The number is probably
I thought you were going to
is
say 4 times
probably
a
higher.
day.
4 times a day. Yeah. No, we at least consolidate, right? Like, yeah, we only have them come once. So it's like, so I think it's like, hey, signs you're in a bubble. Who knows, right? It is objective fact that there's either valuations that are higher in certain segments of the market, right? Like the NASDAQ, S&P 500 from a price to earnings, so I don't know that we can have the crystal ball and tell you when this thing is going to burst. I just go back to everything we've talked about up to this point of just, again, I don't want to own just the Mag 7. It's just not where I want to be in my portfolio ever. Whether or not I have an opinion on when the bubble's going to burst or where that's going to go. It's never a satisfying answer, right? It's like, just gets back to like, I just can't tell you. I don't know. And that's probably, that's probably okay.
Well, yeah, it is. It is absolutely. We don't have to know, what somebody said one time, it's not timing the market, it's time in the market.
Yeah.
And we don't have to be able to predict things to do well in the markets. And that's beautiful. We just have to be able to put up with some uncertainty, which is really hard to do. But yeah, diversification starts to sound like a cliche and like, you always say that, but it's so true. It's like diversification is preparing you for these multiple events that you do not know the outcomes of, such as an AI bubble. And it could go on. We could know, the thing about the markets is we could know the exact information, but if you don't know when, it's useless. So it takes two of those things, the timing of the event and then all the information that the event might have as well. But Nolan, anything on your end you're thinking about?
No, it just goes back to uncertainty. But I will go back to Andy's point. Andy, what I heard you saying maybe is that, again, there are some similarities, but maybe a distinct difference is that in the .com bubble era, the companies that were, getting bid up on the price, maybe their valuation metrics and the fundamentals weren't as strong as what we're seeing today from some of the big companies. And not to say, you want it to be part of a diversified portfolio, but does that make you feel a little better, at least that from what we can at least control of knowing about companies, that maybe some of the fundamentals and their, earnings are there?
Yeah, I think to Charlie's point earlier of like, I want to own companies that make money and are attempting to be profitable, and I still think that exists in the Mag 7, despite the fact that they're overvalued. The other point I'll make is, if we have a downturn, right? Again, we're in an objectively higher valuation market, but if you're on the younger end, say you're a 40, 45-year-old pilot, you're looking at lots and lots of years, 20 plus years of investing in front of you. Like, you're still a buyer. If you just think about your 401k alone with some of those NEC contributions plus yours, 70,000 a year, like you have probably over $1 million of buying in front of you. And so if we do have this market downturn and market correction, you get to buy at prices that are cheaper than they are today. And that's a good thing, right? Like, how do we make some lemonade out of this? Like, just think about where you are relative from as a buyer or a seller, and like, you're a buyer, right? And so I want to buy things at lower prices that have higher returns. That's different than the retiree who's age 60 to 65. Like, you're a seller, right? And so now you've got to think about your portfolio a little bit differently.
Yeah. I think too, there is that psychological component. You talked about this. It's almost like a popularity contest. I can't tell how much that factors into all the numbers, but the prices do get bid up because everybody wants to own those recent returns. You're chasing high returns. I just did a little quick search on some of our software, and I discovered that Amazon's year-to-date performance is 6.3. Apple's is 11.85. And the Dollar General store, my favorite store, because they're everywhere around here, between me and Nolan's house, there's like 1,000 of them, up 48% for the year. Just saying. 48.
There you go.
Dollar General. So that's not a recommendation. That is tongue in cheek. Do not go buy Dollar General store based off of that information.
Yeah.
But it is fascinating sometimes. I like to make that comparison sometimes because people are like, what? The Dollar General store? What are you talking about?
Yeah.
But, well, gents, I think as we wrap up today, I remember back in April when we had our tariff talk. I can't remember the exact titles now, but man, it was a little scary for a couple of weeks there. The market went down significantly. I think there's only been a few other moments since the 1950s where it went down that much that fast. So during that time, you're trying to find things to say or do or how to prepare. So I think every moment we should be ready for that. And some of the stuff, to quote our man Ben Carlson one more time, he put out a piece I thought was excellent. And it was just like, what do you do? And some of the things, I'll call them axioms, that he put out basically were, he said, if I knew what was going to happen, there would be no reason to diversify. My plan for surviving chaotic markets looks like this: automate good decisions ahead of time, follow my investment plan even when it feels uncomfortable. That's that uncertainty we talked about. It's going to be uncomfortable and there will be uncertainty. Diversify my portfolio to account for different market environments. Do not obsess over short-term market movements. Do not let short-term volatility dictate how you live your life. In other words, don't get stressed out. Life will go on. Markets will tank. They will correct. They will be in bear market territory, whatever phrase you want to use there. And finally, every investor needs their own survival plan. The most important thing is having a plan in the first place. And I think for us and our pilot audience, it's just like the simulator. We've practiced these things in the simulator. We talk about them. It's always different if it happens in the airplane. But nonetheless, at least you're prepared. At least you've talked about it. At least you know some initial actions. And it could be a little less stressful, with those things in place, those processes of talking about it, thinking about it, preparing for it. And so we've seen where that has a major impact when the time does come, and it will again. But first, parting shots. Nolan, I'll give you the mic, and then Andy, pass it off to you for any final parting shots. What do you think?
Yeah, I like what you said about just expect those down markets to come, right? And I think it's good to kind of go through it in our heads. Do the fire drill when there's a fire. You do it beforehand, so you can be as prepared as possible. And so nothing can truly simulate that until you go through it. But I think it's a great point. I'll just end on this. Missing the 10 best days in the market over 30 years would cut your gains in half during that time. And so just to say that you can't time it, and that's a very short period of time, right? That can make up a lot of gains, and you never know when it's going to be. And April was a prime example of that. I don't think many analysts that we were listening to thought that 2025 was going to have the year it did or has so far. So
yeah, you're right about that. Andy, drop some knowledge on us before we go.
No, I love the point you made about short-term, like don't let short-term emotions affect your long-term investing. I've had a few opportunities where you actually think about putting money into the market, like not just a 401k. And every time I'm like, man, I hope the market doesn't go down, because that's our natural reaction. Like I just put all this money in, and I'm trying to look back on it. Like I have zero emotional attachment or memory of those times. I remember I was at the academy, and they give you a career starter loan, which is just like a 0% interest loan. And that was, for me, I graduated 2009. So fall of 2008, they give you, it's like $30,000. And you're like, first of all, you're like, why do I need this? But everyone else is doing it, so I'm going to do it. And I was like, I'm going to invest it. I put it in the market. 2008, right? Like terrible time. And now looking back, I have no idea. I have no clue emotionally what that, I have zero emotional attachment to that experience 15 years ago. And so I think time in is more important than timing the market. And so just, that those emotions will feel intense in the short term. They will dissipate over the long term from an investing perspective. And those are the emotions that matter more.
Yeah, that's great. I thought you were going to say you put that money in March of 2009, and now it's worth like $3 million or something, but not such luck, huh?
No such luck. Not a good timer. Not a good market timer.
And what you're saying is the exact opposite. It kind of didn't matter at all. Distance kind of, the time
that's
kind
right.
of healed all of that stuff. You're right, man. That's a great point. What we think is super important right now, we won't even remember,
that's right.
5, 10, 15 years from now. But awesome. Thank you all for joining us today. Again, thanks to our pilot audience for sharing our podcast. Shoot us a message. Let us know if there's any topics that you'd like us to cover. We'll do that. We'll take a look at them and cover them. We hope everyone has a great holiday. Thanksgiving's passed already, but we hope everybody has a great Christmas celebration, holiday period. I think we'll have one more podcast coming out before the end of the year. Thank you so much, and we'll talk again next time. Thank you. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.